Hi, it's Jenny Kassan here to lay down the law as I do every week, where I talk about legal issues and strategy issues related to fundraising for mission-driven businesses, especially outside the box types of investing where the entrepreneur can stay in control and grow on their own terms. And so I'm in a car today. I had a little emergency come up, so I'm doing this from a car, but that's cool. So what I wanted to talk about today is some things that you might want to think about if you're thinking you might want to raise money in the form of equity. So equity can be a really great way to raise money. You're basically selling a piece of your business. You're selling an ownership interest in your business. So if you can't do it if you're a nonprofit, but if you're like a co-op or an LLC or a corporation, you can do this. And you really can, you have lots and lots of options when it comes to the terms of the equity. A lot of people think that when you sell equity, you kind of are signing up for a certain type of path that is what we call the venture capital path, where you're giving up control and you're being pushed to, sell the company at a high valuation within 5 to 7 years, or else you're a failure. But that's just one type of equity investment. Anything you want, pretty much, you can put into the terms of an equity investment. That model where you're being forced to sell the business in order for the investors to ever make money, that's just one design. You don't have to do it like that. So I'm just going to quickly talk about some provisions of your equity term sheet that you can think about how you want to structure them. So the three provisions I'm going to talk about today are profit distributions, aka dividends, redemption provisions, and liquidation preference. So first, I'm going to talk about profit distribution. So in the venture capital model, there's generally no profit distributions, because in that model, your main purpose is to grow as fast as possible. And so any money that comes out of the business, any profits, if you are profitable, your investors really don't want you to pay profits out to anyone. They want to invest any money. They want you to invest any money you have into the growth of the business. Buy more marketing, advertising, buy more, hire more team, do whatever you can to grow. So generally speaking, in that model, you're not going to be paying out any profit sharing. But if you're not on the venture capital path, I think it's a really great idea as your business starts to become profitable to start to share those profits, in a healthy way with your investors. And there's lots and lots of ways to do that. It could be just a discretionary dividend based on whatever the board feels is appropriate. There could be a target dividend where you say, we're not sure if we're going to be able to pay a dividend every year, but to the extent that we can, we will pay a certain target dividend. And unless we pay that target dividend, the founders won't be able to take profit out of the company. So those are a couple models of dividends. There's all kinds of creative ways you can design the dividends to make sure that you're not putting your business at risk by incurring obligations that are going to be too onerous, but you're also rewarding investors as your company becomes more profitable. And the nice thing about paying out dividends on an annual basis, once you're able to, is it really takes away that pressure to sell the company, because your investors don't have to wait for you to sell the company for them to start making money. So I always talk about equal exchange. They're a business that pays an annual dividend of 5%. So 5% of what each investor invested, they get that every year. It's not a requirement that the company pay that, but they do pay it every year pretty much. And people love that. They're happy to stay invested over their whole lifetime, leave the stock to their kids, because 5% a year is actually quite a good return when you compare it to the ups and downs of the stock market. So that's number one. That's dividends, or dividends are the name of it in a corporation. In a LLC, it's probably going to be more likely to be called distributions. Okay, the second thing I wanted to talk about is redemption. So redemption is when the investor sells their equity back to the company. And there's lots and lots of ways that can happen too. A lot of businesses, in the VC model, there isn't usually much about redemption in the typical VC term sheet. There really isn't a provision that allows either party to require a redemption, because that's just not what that model is. But you may want to design a redemption option that allows your investors to exit when they're ready to exit. So for example, in the equal exchange model, there really is no exit from that investment because the company doesn't have plans to ever sell. But if somebody wants to exit or from their investment and get their original investment back, they can request a redemption. And the provisions in the governing documents talk about how that can happen, how the request is made, when the request can be made. The company is not required to honor the request, but if there's provisions about what you get if you do get a redemption. Basically, in the case of equal exchange, the redemption price is the same as what you originally paid for your stock. So the price of your stock does not go up, but you can get back what you originally invested if you make that request and they're able to honor it. So that's a nice way to allow people to exit without you being pushed to sell the company. You can also have redemptions at a higher price. You can have, there's different ways to determine the price. The price could be variable based on different factors, or you could have an independent appraisal done at the time of redemption. There's a really neat model where there's kind of like a mandatory annual redemption. To the extent the company has profits, the company pays out a certain percentage of profits, and that payment is a redemption of the stock. So little by little in that model, the company is actually buying the stock back over time, and you can buy it back at a multiple, like at a higher price. So that's a really cool model. So that's redemption. And you can have the company have the right to require redemptions. You can have the investor have the right to request a redemption. You can never have a situation where the investor can force a redemption, basically, because if the company doesn't have the solvency to pay a redemption, it's legally not allowed to do that. So the third thing is liquidation preference. And liquidation is what happens when the company goes out of business or is sold, basically. And so you can give your equity investors a preference of what they get if that happens. And a preference just means that they're first in line to get any money out of that situation. So for example, if something bad happened and your company went out of business and your investors had a liquidation preference, they would get first dibs on any money left over after you paid off your debts. But if there was a scenario where you sold the business and you had that really awesome thing happen where you found the perfect buyer and they bought it for a huge amount of money and it was so great and you were really happy, a liquidation preference would mean that your investors would get first dibs on the money from that liquidation. And you can figure out what the details of that would be. It's often what we call a 1x liquidation, which means that before you as the founder get any money, they first get back the same amount of their original investment, and then maybe you share in the remainder with them on a pro rata basis, basically, or based on your percentage ownership. But again, there's lots and lots of ways to structure that. So those are just 3 terms to think about. And really, if those 3 are super, probably the most important ones to think about, that really covers a huge percentage of what you would want to think about when structuring your equity investment for you with your investors. And these are all things that need to be reflected in your governing documents. So like your articles of incorporation, if you're a corporation, or your operating agreement, if you're an LLC. bylaws or potentially articles of incorporation if you're a co-op. It depends on the state law where this has to be. But it all needs to be in your governing documents, clearly laid out who gets what, how it's all calculated, etc. So I just wanted to give you some ideas about some of the creative things you can do. And, when you're thinking about what to do, just think about what makes the most sense given what you see as the trajectory of your business. So I wanted to let you know that I go over all of this in a lot more detail in my book, Raise Capital on Your Own Terms. And there's actually a sale on that book right now. My publisher is having a holiday sale. The publisher is called Barrett Kohler. They're a really amazing company. They were actually my client before they were my publisher. They're just such a great company. So they are incredibly mission driven. They have community ownership, worker ownership. They also have like a lot of charitable activities that they do. So if you want to support a great company and buy my book, you can go to their website, BK Connection. And in step 3 in my 6-step process that I talk about in my book, I go into a ton of detail about different provisions and examples of term sheets. In fact, when you buy the book, you get access to a website that has examples of term sheets you can use to start talking to investors. All right, I'll see you next week. Bye.